Hello everyone and welcome to the YouTube channel of Being ACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are continuing with our section B questions. This is the second OT case study from your FM pre-June mock exam. So let's get started. The name of the company is Tudor Company. Tudor Company's finance director is concerned about the impact of changes in the interest rate in the future on the company. As a result, she has been looking at the yield curve. Tudor Company, whose domestic currency is the US dollar, plans to take out a $50 million loan in 4 months' time for a period of 8 months. The company is concerned that the interest rates might rise before the loan is taken out. So the bank currently offers you these FRA agreements, FV8 and FV12, FRA at 7.10 and 7.3. My apologies. The loan will be used to invest a project in a country whose currency is dirhams. The 8-month project is expected to generate income of 600 million dirhams, with 200 million dirhams being received in 6 months' time from today and 400 million dirhams being received in 12 months' time from today. The spot exchange rate currently is 4 dirhams per $1. So $1 is going to give you 4 dirhams. The following information on the current short-term interest rate is available. As a result of general uncertainty over exchange rates and interest rates, Tudor Company is considering a variety of ways in which to manage its interest rate and foreign exchange risk, including the use of derivatives. So the very first question that we have with respect to this one is that which two of the following hedging techniques can be used by Tudor Company to protect against a rise in interest rates? So because they want to borrow money over here, they are basically wanting to get protection against a rise in interest rates. So number one, money market hedge is not going to help them. Money market hedge is used for foreign exchange risk. This is interest rate risk. Hence, this option gets eliminated. The next option is interest rate collar. Collar basically is something in the middle of a cap and floor. So definitely this can help them against a rise in interest rates. Then when you talk about a cap also places a maximum amount of interest that, the maximum interest rate, it puts a cap on that. So this is also something which can help them to protect against a rise in interest rates. And then the next option that is available is interest rate floor. This is not your answer. Floor is basically helpful if you want to protect against a fall in interest rates when you're looking to invest, when you're looking to deposit. So this is not something which is going to help you over here. Moving ahead, this is question number 22. Select the correct combination from the boxes 1 and 2 regarding the payouts related to the FRA if the interest rate on the loan is 6.5% when it is actually taken out. So let us go back to the information that was provided with respect to the FRA agreement. So basically, they are going to have to take a loan of $50 million in 4 months from now. So it begins for after 4 months. So 4 is going to be there for sure. And after those 4 months, it's going to be a period of 8 months for which they are borrowing. So ideally, they will be going for this agreement, 4 months until they get into that loan, and then additional 8 months for which they borrow that loan. So FRA needs to be 4 to 12. So over here, they have entered into this FRA. So let us see which boxes do we have. Okay. And then the other one is okay. So the first one is that the first step over here is that we decide that it's going to be this FRA over here. Now, the rate at which they have already, when they took out the loan, the rate was 6.5, and they have locked the actual interest, the FRA, to be at 7.3%. So let us find out first what is going to be the difference. So the difference is nothing but 7.3% minus what you have, what the actual rate was when you took out the loan, which is 6.5%. So this over here is the difference. 0.8% is your difference. The rate actually which you have logged in is higher, and the actual rate was lower. So if you see, this needs to be multiplied by 8 by 12 because this is a borrowing for a time period of 8 months. And then this needs to be multiplied by your loan amount, which is $50 million. So the figure which we are looking for when it comes to the box 2 is 2,666,667. So this is the figure that we will be selecting when it comes to box 2. Now let us see who is going to give the payment to who. Over here, you are actually agreeing to pay the bank more, and the actual interest that bank is charging you is lesser. So because over here your rate which you have agreed is higher in the FRA, Tudor company is going to pay to the bank because they are initially what the bank is charging is 6.5%, but they have promised to pay 7.3. So this much extra Tudor company will have to pay to the bank. So let us move to the next one. Using exchange rates based on interest rate parity, what is the dollar income received from the project? So over here, I will first have to find out the exchange rate, and then I'll have to find out the value of my receipt. So over here, this is question number 23. Now, first I need to find out the interest rate. So the exchange rate. So exchange rate is supposed to be the spot rate, which is 4 multiplied by 1 plus the inflation in the counter currency. Counter currency is dirhams. So 1 plus 8%. Over here, we are looking at these are per year interest rates, and over here the income which we are going to be receiving is 6 months and 12 months. So I need both a 6-month rate and a 12-month rate. So to first calculate the 6-month rate, I need to divide all of these interest rates by 2. So 8% divided by 2 gives you 4%. And then this needs to be divided by 1 plus the inflation, or sorry, the interest rate in my domestic currency, which is dollars. So 6% half is 3%. I close both of these brackets, hit enter. This is what my exchange rate is going to look like 6 months from now. This is 6 months. And now let's do for 12 months also. 12 months again, I can just copy paste and change the numbers. Only I have to use the annual figures here. This is 8% and this over here is 6%. So this is what my exchange rate is going to look like 12 months from now. So the next thing that I need to do is convert my cash flows. Number one, I'm going to have 200 million dirhams being received in 6 months time. So the 6 months exchange rate I've already found out. This is the exchange rate that we have. So 400 divided by this value is what is going to be my receipt. So I'm going to receive over here, 200 is my receipt. So 200 divided by 4.038, which I found out as the exchange rate. This is the receipt that I'm going to have 6 months from now, and 12 months from now, I have 400 million dirhams divided by this value. So I will have 98. So if I just add both of these things over here, I will have my total expected dollar receipt. I can simply say this value plus this value. So my final answer is $147.7 million. Moving ahead, this is question number 24. 24 wants you to find out which of the statements are true. Tudor company is unsure whether to use a forward contract or a money market hedge and is comparing the relative advantages and disadvantages of the two. So which two of the following statements are true over here? The first statement says the forward contract and the money market hedge have the advantage of being tailored precisely to Tudor company's requirement. Definitely. Money market hedge is also being tailor-made, and then your forward contracts are also OTC. These are custom-made arrangements specifically made for you. Then moving ahead to further statements, Tudor company will be obligated to fulfill the forward contract, whereas money market hedge could be traded on the exchange to another party before settlement. Again, this is incorrect. Why? Because forward contract they will definitely have to fulfill, but even the money market hedge, they cannot trade it in the market because it is custom made according to their requirements. Hence, they cannot really trade it in the market. So this statement is incorrect. The forward contract will result in the effective exchange rate being fixed, whereas the money market hedge will allow Tudor company to benefit from the favorable movement in the exchange rate. No, this is not true, because they both effectively fix your exchange rate. It is not only the forward contract which will fix the exchange rate, your money market hedge also fixes the exchange rate. The forward contract will result in Tudor company receiving the dollar equivalent of the dirham receipts in 6 months and 12 months time, whereas the money market hedge will provide Tudor company with the dollar receipts today. Now, this is absolutely correct. When you talk about your, forward contract, basically you will be receiving money 6 months and 12 months of time. And if you take a money market hedge, basically you're going to do BCD, borrow, convert, deposit. So conversion happens today. So the receipts that you have is going to be in dollars today with you. So this statement is also absolutely correct. Moving ahead to the very last question for this case study, in relation to the yield curve, which of the following statements is or are correct? Expectations theory suggests that investors require increased compensation as maturity increases due to risk. Now, this statement is not correct because it is not the expectations theory, but the liquidity preference theory. Liquidity preference theory says that all of your yields should rise with maturity because investors require more return for the risk of money being tied for the longer time, because they are preferring to have liquidity because you're taking money from them for a longer period of time, hence they want more return. So this is not the expectations theory but your liquidity preference theory, hence the statement is incorrect. An inverted yield curve can be caused by government action to tackle inflation. This is absolutely correct. Whenever the government is tackling high inflation, this basically means that the interest rates will be kept higher in the short term with the expectation of, having a fall in the longer term. So the curve basically is going to be inverted. So option 2 over here is correct. A kink discontinuity in the normal yield curve can be due to differing yields in the different market segments. This is exactly what we have studied. So 2 and 3 are correct over here. With this, we are done with this case study, Tudor company. I hope that this was useful and I will see you in the next video for the next question.